Welcome to the latest IFRS 15 Basics video. Step 5. Recognise revenue when or as a performance obligation is satisfied. I'm sure you remember the IFRS 15 5-step model. In the previous videos, we have considered Step 1 to Step 4, where we have identified a contract with a customer, found the performance obligations within the contract, and then determined and allocated the transaction price. Today, we will cover the last step, Step 5, recognise revenue when or as a performance obligation is satisfied. In the previous video that looked at how to identify a performance obligation, that is Step 2, we made the point that a performance obligation will be key to determine how and when revenue is recognised. The core principle underlying IFRS 15 is that revenue is recognised when or as the entity satisfies performance obligations. A performance obligation is satisfied when control of the promised good or service is transferred to the customer. A customer obtains control of a good or service if it has the ability to direct the use of and obtain substantially all of the remaining benefits from that good or service. A customer could have the future right to direct the use of the asset and obtain substantially all of the benefits from it, for example, on making a prepayment for a specified product, but the customer must have obtained those rights for control to have transferred. The concept of control of an asset might appear to apply only to the transfer of a good, but a service also transfers an asset to the customer, even if the asset is consumed immediately. For example, the provision of a cleaning service might be transferred, but then consumed immediately. Directing the use of an asset refers to a customer's right to deploy that asset, allow another entity to deploy it, or restrict another entity from using it. An asset's benefits are the potential cash inflows or reduced cash outflows that can be obtained in various ways. Examples include using the asset to produce goods or provide services, selling or exchanging the asset, and using the asset to settle liabilities or reduce expenses. The assessment of transfer of control should be primarily from the customer's perspective. As such, there is a reduced risk that revenue is recognised when the customer does not receive control of the good or service. Additionally, there's a need to consider whether there is an option or a requirement to repurchase an asset on the part of the seller when evaluating whether control has transferred. Under IFRS 15, there are two possible ways in which control can transfer, either over time or at a point in time. Depending on whether over time or point in time are used will impact when revenue is recorded. The analysis of a contract should be made at its inception, as there is a need to determine whether control of a good or service transfers to a customer over time or at a point in time. It is over time assessment which must be considered first. If the recognition is not over time, then revenue should be recognised at a point in time. Arrangements where a performance obligation is satisfied over time is not limited to service arrangements. Complex assets or certain customised goods constructed for a customer could also transfer over time, depending on the terms of the arrangement. Clearly, this assessment is critical to the timing of revenue recognition, and the assessment also links back to Step 2 when we considered the series guidance. So what criteria do we need to look at to see if control transfers over time? The first criteria is to determine whether the customer simultaneously receives and consumes the benefits provided as the entity performs. This criterion primarily applies to contracts for the provision of services, for example, a cleaning service. An entity transfers the benefit of the services to the customer as it performs, and therefore satisfies its performance obligation over time. This criterion could also apply to arrangements that are not typically viewed as services, such as contracts to deliver commodities such as electricity. An entity that provides a continuous supply of natural gas upon demand might conclude that the natural gas is simultaneously received and consumed by the customer. An additional indicator would be if another entity does or would not need to substantially reperform the work completed to date to satisfy the remaining obligations in the contract. If this is the case, then the first criteria will be met and revenue will be recognised over time. The second criteria is to assess whether the entity's performance creates or enhances an asset, for example work in progress, which the customer controls as the asset is created or enhanced. The asset being created can be tangible or intangible. Such arrangements could include construction or manufacturing contracts where the customer controls the work in process, or research and development contracts where the customer owns the findings. The final criteria to be assessed is whether the entity's performance does not create an asset with an alternative use to the entity and the entity has an enforceable right to payment for performance completed to date. This criterion will probably be applicable when goods or services are specific to the customer. An example could be a contract to provide consulting services where the customer receives a written report when the work is completed, while still being obligated to pay for the work completed to date if the contract is cancelled. Revenue is recognised over time in this situation since no item with an alternative use is created. The report is specific to the customer, and the right to payment is assumed to compensate the entity for performance to date. Let's consider the details for the last criteria on the next slide. So, how should the last of the overtime criteria be analysed? We need to look at an alternative use as well as right to payment. An asset has an alternative use if the entity can redirect that asset for another use or to another customer. An asset does not have an alternative use if the entity is unable, because of contractual restrictions or practical limitations, to redirect the asset for another use or to another customer. Contractual restrictions and practical limitations could exist in a broad range of contracts, so judgment is going to be needed when determining whether an asset has an alternative use. Moving on to right to payment, an entity has a right to payment for performance to date if the entity has the right to payment at all times during the contract term, even if the customer terminates the contract for reasons other than the entity's non-performance. The assessment of whether a right to payment exists may not be straightforward and depends on the contract terms and relevant laws and regulations. An entity's right to payment does not have to be present, an unconditional right. Many arrangements include terms where payments are only contractually required at specified intervals or upon completion of the contract. A right to payment would also exist if the contract or other laws entitle the entity to continue fulfilling the contract and demand payment from the customer under the terms of the contract in the event the customer attempts to terminate the contract. In all situations, the amount of payment must at least compensate the entity for performance to date at any point during the contract. The amount should reflect the selling price of the goods or services provided to date, rather than compensation for only costs incurred or the entity's potential loss of profit if the contract is terminated. So the amount would cover an entity's cost plus a reasonable profit margin for work completed. So, if only costs incurred are covered by payment, then under IFRS 15 there would not be a right to payment. Once confirming that revenue should be recognised over time, there's a need to measure progress toward completion, which in turn determine the timing of revenue recognition. So, measuring progress towards satisfaction of a performance obligation recognises revenue in a pattern that reflects the transfer of control of the promised good or service to the customer. Methods of measuring progress include output methods that recognise revenue based on the direct measurement of the value transferred to the customer. Examples of such output measures include surveys of work performed, units produced, units delivered, and contract milestones. Output methods directly measure performance and can be the most faithful representation of progress. However, in some circumstances, it can be difficult to obtain directly observable information about the output of performance without incurring additional costs, in which case it might be necessary to use an input method. Input methods measure progress based on resources consumed or efforts expended relative to the total resources expected to be consumed or total efforts expected to be expended. Examples of input methods include costs incurred, labour hours expended, machine hours used, time lapsed, and quantities of materials. Judgment is needed to determine which input measure is most indicative of performance, as well as which inputs should be included or excluded. An entity using an input measure should include only those inputs that depict the entity's performance towards satisfying a performance obligation. Inputs that do not reflect performance should be excluded from the measure of progress. It is possible to elect to use a practical expedient to recognise revenue based on amounts invoiced to the customer. If an entity has a right to consideration from a customer where the amount corresponds directly with the value which the customer gets based on an entity's performance to date. Evaluating whether an entity's right to consideration corresponds directly with the value transferred to the customer will again require judgment. A negotiated payment schedule won't automatically imply that the invoiced amounts represent the value transferred to the customer. The market prices or standalone selling prices of the goods or services could be evidence of the value to the customer. However, other evidence could also be used to demonstrate that the amount invoiced corresponds directly with the value transferred to the customer. As a practical input method, time-based method might be appropriate in situations where the performance obligation is satisfied evenly over a period of time, or the entity has a stand-ready obligation to perform over a period of time. It is not appropriate to default to straight-line attribution. However, straight-line recognition over the contract period is often reasonable. Examples could include a contract to provide technical support related to a product sold to customers, or a contract to provide a customer membership to a health club. When selecting the method to measure progress over time, there is not a free choice. The method of measuring progress should be the best method which depicts the transfer of goods or services to the customer. What about when a performance obligation is satisfied at a point in time? This will be the case if none of the criteria for satisfying a performance obligation over time are met. If control is passed at a point in time, then there is a need to look at when the customer has the ability to direct the use of and obtain substantially of the remaining benefits from that good or service. That is when control has passed. IFRS 15 provides 5 indicators that a customer has obtained control of an asset. The entity has a present right to payment. The customer has legal title. A party that has legal title is typically the party that can direct the use of and receive the benefits from an asset. The benefits of holding legal title include the ability to sell an asset, exchange it for another good or service, or use it to secure or settle debt, which indicates that the holder has control. An entity that has not transferred legal title, however, might have transferred control in certain situations. An entity could retain legal title as a protective right, such as to secure payment. Legal title retained solely for payment protection does not indicate that the customer has obtained control. All indicators of transfer of control should be considered in these situations. The customer has physical possession. The customer has significant risks and rewards of ownership. And the customer has accepted the asset. A customer acceptance clause provides protection to a customer by allowing it to either cancel a contract or force a seller to take corrective actions if goods or services do not meet the requirements in the contract. This is a list of indicators, so not all of the indicators need to be met for management to conclude that control has transferred and revenue can be recognised. management needs to use judgment to determine whether the factors collectively indicate that the customer has obtained control. The assessment should be focused primarily on the customer's perspective. Just a quick note. It's perfectly possible to have performance obligations within the same contract, some of which are recognised over time and some at a point in time. You've now been through the 5 steps in IFRS 15. The 5 steps are clearly not always so easy as they seem. However, I hope you understood the core principles to be used in practice. I hope that the video series has been helpful. To learn more, please visit our PwC website or PwC Inform. Thank you.